Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell in stocks. We are lower here. The Dow's down by 50 points. Your broad gauge, the S&P 500, down by about 0.7%, and your tech-heavy NASDAQ down about 1.5%. Let's welcome in now. We have Defiance ETF's CEO and Chief Investment Officer Sylvia Jablonski, our data and markets editor Jared Blickery, and senior reporter Alec Now joining us here to break down the headlines. Jared, give us the latest on today's trading action.
We are seeing a bit of a sell-off today. It is concentrated in tech. So let me just start out with the Dow. Not doing too bad. It's only down 65 points. You can see it started out in the green and just drifting down into the red, barely off of the lows right there. And a very different story for the NASDAQ. You can see it's been in the red all day and hovering around the lows of the day right now, down 1.5%. Worst day in a while. And the S&P 500 kind of in between here. It's down about half that, or 0.7%. Also seeing some selling in the Russell 2000, but not as bad as we're seeing in the NASDAQ. Also want to flip through the bond market real quickly. We're seeing the 10-year and the 30-year each down about 4 basis points. 10-year is down to 4.3% and the 30-year down to 4.9%. US dollar index catching a little bit of a bid there, but watch what's happening in sector land. This is interesting. The top sectors here are either interest rate sensitive or defensive sectors. So you got real estate outperforming, that's as bond yields are coming down. Staples, utilities, healthcare, arguably defensive sectors. Those are doing all right, 7 and 0.6% respectively. And then here's tech, the only sector that is doing worse or underperforming the S&P 500 itself, down almost 2 percentage points. And then you have some of the tech-like sectors, communication services and consumer discretionary, where you have Amazon, Tesla, et cetera. Those are doing not so well as well. And if you take a look inside the NASDAQ 100, a lot of red, especially in some of the bigger issues. NVIDIA down 3.5%, Broadcom down 4%, Palantir down 9%. Haven't seen Palantir down that much in a while. But let's take a look at the equal weighted. And I think this is interesting. A lot of these stocks on the bottom row that are doing the worst today have recently been overbought. So they've been doing well momentum-wise recently, and a lot of the stocks on the top, and there's Intel at the very top. Guess what? Some of those, most of those are underperformers for the year, and they have not been doing so well momentum-wise. So we're just kind of seeing some rotation into stocks that haven't gotten so much love recently. We just did the sectors, so let me do the Dow right now. So let's leave off some of the mega caps that we just covered. What's doing well in the Dow? Well, we got Merck up 1.5%, healthcare doing well, Home Depot, that's an earnings story, up 3%, Staples, Procter & Gamble up 1.5%, Cola in the same bucket as Procter & Gamble. So you put it all together, really interesting day. And here's the transports. We're seeing a lot of green here. Uber up 1.5%, 1.25%. Some of the railroads doing nicely. FedEx up 2%. So a lot of rotation in the mix, but tech really leading the way down.
All right, Ali, despite big tech driving much of the recent surge we know, some analysts say the stock market's next leg higher is going to be sustained by broader participation. Ali, what is the latest on that theory?
Well, I think Jared just nailed it. You're seeing that play out in today's session with big tech underperforming. Big tech has really led the bull market run since 2023. And you're seeing a lot of those more beaten down sectors, those defensive sectors, leading the way higher today. Now, Citi strategist Scott Kroner, he had a note out on Friday saying that for the S&P 500, this is healthy. This is a good thing when we talk about the sustainability of this rally. And he sees the S&P 500 going down 2 parallel paths. One path is fueled by a lot of those AI growth names like your NVIDIAs of the world. Then the other path is those sectors that are more economically sensitive, that are tied to interest rates and what's happening in the broader economy. Of course, the Fed is a big part of this story, right? And there's been greater expectations that we'll be seeing a Fed rate cut in September. Jackson Hole coming up at the end of this week. Markets are going to be really focused on that to see what Jerome Powell has to say, if there's any indication on the path forward when it comes to interest rates. But I also spoke with UBS on Monday about this rotation, how they're looking at this broader participation. And that they told me that it's a bit of a mixed bag. Strategist Sean Simons, he pointed out that while momentum in AI is expanding beyond just those typical tech players, it's spilling into areas like software, power, there are still those sectors like consumer and healthcare that remain under pressure. So even though they are doing well today and we're seeing them tick up from where they were, relative to the broader market, they are still pretty weak. So that is something to keep an eye on. They also added a word of caution for small caps, that in order for small caps to continue to rally, they're going to need this Goldilocks scenario. And that's a scenario where the Fed cuts interest rates and the markets don't freak out, that they continue to trade higher. So that is a very difficult position for small cap companies, which have really been underwater for quite a few years now. But it is important for, the broader swath of stocks to continue to see these gains in order to keep this rally going. So that's what it comes down to, right? If we can see that sustained momentum, not just in big tech, but across all of these different sectors.
And Sylvia, I want to get your thoughts on here as well. Do you imagine, Sylvia, investors rotating from mega caps into other sectors? Could that drag down the market potentially?
Well, I actually think that what's happening in the market today is par for the course, right? I think these small corrections in the market, whether they're 2%, 5%, sometimes even higher, are actually healthy. I agree with the report that was referenced. This is part of a healthy S&P 500 in a market scenario. We're also here towards the end of August. We have unclear Fed policy and things like this. But what I think is that most investors have a lot of exposure to Mag 7. So I think allocating to X Mag and looking at the other, 493 names in the S&P 500 is never a bad idea to diversify and broaden out your exposure. There's a lot of ETFs that you can do that with. And, for those investors who aren't in these days where you have these dips and pullbacks in the market, tend to be opportunities to buy into the market. The other comment that I agree with that Ali just mentioned is that, AI isn't just the Mag 7, right? We've been talking about the broadening trade of AI and how that goes out to AI power, that goes into quantum computing, supercomputing, cybersecurity, hyperscalers, things like this. I still think that there's a lot of appetite for that. And so maybe it won't be classic Mag 7 allocations because, again, most of us already have it. Maybe it'll be an expansion on the pullbacks into some of those other areas like AI power, quantum computing, and things like this.
All right. Thank you, Jared. Thank you, Ali. Appreciate it. And Sylvia, I want to get your thoughts on one argument I've heard from investors. Some of them, Sylvia, is saying they're getting, and this is the word they use, they said, we're getting a bit uneasy.
Yes.
Kind of uneasy because of the valuations. We're looking a bit stretched here. We're looking a little rich. Do you share that unease?
I think it's so interesting to watch investor behavior, right? Because when we had Liberation Day and the market kind of crashed in April, there was a lot of
freak out.
There's a freak out, and there was a lot of selling. And actually, you and I were together around that time talking when the index was down 400, 500 points. NASDAQ in particular.
You were a voice of calm and reason,
right?
Sylvia, you were.
Right, and you think about those days, and those do end up being dip buying opportunities. So, but you're asking specifically, are we overvalued? It's hard to say because if you look at corporate earnings, at this point, most of the companies have reported. Over 80% of them have beat on EPS. Same number for revenues. The growth outlooks look pretty good. The economy's solid. Job numbers softened a little bit, but they're not so bad. So, my point is that the macro backdrop is still pretty good.
So the valuation is justified?
I think the valuation is justified, but you never want to be in this position as an investor where everyone is just kind of bullish on everything. There's no end. You can see today that there are corrections, and so it's okay. Par for the course. Long-time investor, hold it,
Sometimes stocks go down.
Sometimes stocks do go down.
Yes.
And I think there are always opportunities to get into stocks or areas of the market that you don't have exposure to. So I don't think so much about, one day or if the market is overvalued today, I'll just kind of look at the breadth of stocks that give me opportunities to catch that next leg of technology, for example.
Let me ask you this. If it's not valuations,
yes,
what would be on your radar of concerns? Would it be tariffs? Would it be geopolitics, the Fed? What?
Exactly, because I think, valuations are high, but I think, again, it's a strong market. And so I would like to participate in the upside of equities. They do look better than fixed income products right now. They do look better than those tax-free money markets that we had, a couple of years ago where, people were arguing that like, hey, 5% is better than equities. It's just not the case anymore, right? So I think I worry about tariffs. I worry about geopolitics. I worry about those unforeseen types of, war scenarios that we don't know about. That's really what it comes down to.
What about the Fed? You mentioned. I feel like we're getting very wound up about Jay Powell, Jackson Hole, and Friday. I can feel like the tension building.
Right.
Should we be this tense about this speech?
So this is so interesting because if the Fed cuts, that means that the economy is essentially softening, right? And it means that the conditions are a little bit worse than they were in the months prior when the Fed decided not to cut. And so, but for whatever reason, the market psychology is that a cut is good and you might get equity performance, outperformance on the day that he actually cuts. So kind of, I think we're at the beginning of the potential Fed cuts. I don't think that there will be meaningful impact in the market, but I do think market sentiment will be greater than the impact in the short term, meaning stocks may pop on that. And yeah, I think all ears will be on, what he says in Jackson Hole, but I think the speech will be towards talking about these cuts, potentially.
So let me ask you this. Bottom line, give me the Sylvia playbook right now. What does look interesting to you? Where's the opportunity?
Yeah, I always look at, AI was like the trade, right, of the last year. So what is next in that? I think you need to power AI, right? So I look at AI power. I look at quantum computing and supercomputing. These are my focuses on tech. And also geopolitics, we just mentioned that. Think about drone companies. Think about modern warfare. There are places to put your money to work.
I know you're bulled up on AI.
Yes.
I have to ask you, when you hear Sam Altman, right, OpenAI king, right, you hear from the mountaintop, and Mr. Altman says he's kind of warning of an AI bubble. What do you make of that?
Well, I think
Does that get you nervous when you hear that?
I think the hype, there is this hype around AI, and there's this hype around a specific number of companies in AI. But the fact is that even if it stays where it is, you're going to need continued power and energy for this to continue to grow, scale, and just maintain, right? So there are certain parts of the market that are almost like utilities for AI that could potentially benefit, right? I do think that, you're in the infancy of quantum computing. That's not straight AI, that's something else, right? But they kind of work together. Quantum computers can train machine learning, can train AI. And so I do think that you have these offshoots that are good places to go, even if you think the classic AI is in a bubble.
That AI CapEx theme, by the way, is so big and so powerful.
So big,
and when you listen to this last earnings season, it certainly looks intact.
Yes.
Does that in some way cover up a lot of potential concerns?
I think that, it's good to see that high level of it's good to see that these companies continue to have confidence and they're allocating their balance sheet towards spend on AI. That tells us that they think they can monetize on it, or they wouldn't do it, right? And so I think for the near term, that's news that we want to hear. But what I want to see in the next few earnings seasons really are the other sectors and how they're monetizing AI, how they're actually using it, and how it's cut their costs, how it's boosted their revenues, and things like this. I think once it starts to seep into things like, healthcare, aerospace, and defense conversations, and not just the classic tech companies, that's when we'll have more confidence about the future path of AI.
Finally, NVIDIA, the face of AI, right?
Yes.
Earnings on deck next week. How important is that, Prince Sylvia, for the AI trade and trend, but also even just the broader market?
Yeah, I think AI, there's always the stock of the year that seems to drive the market. It's kind of been Apple, it's been Tesla, it's been NVIDIA now for a few years, I would argue. So it's really the bellwether of the market. I do think that everyone will be watching, and if the numbers are positive, that will give momentum to everything related to AI, whether it's Mag 7, whether it's tech, hyperscalers, things like this. And if it's below expectations, then you'll see some pullback.
Is it too simplistic to say I listened to those big tech earnings calls like you did too?
Yes.
Spend on AI infrastructure. Shouldn't that mean I should expect pretty good news from NVIDIA?
We would expect good news from NVIDIA. I think the question going forward will be the impacts of tariffs and potential government-related costs and things like that. How does that impact the bottom line? But everything that we know indicates that they can't keep up with demand. Supply is growing larger than demand, and
good place to be.
It's a good place to be.
All right, thank you, Sylvia. We are just getting started here on Market Domination. Coming right up, will new leadership be the silver bullet open door needs? Plus Palantir plummeting today. We're going to tell you why. And we're taking a deep dive into semiconductors. We're going to tell you why Intel's popping, all those stories and more when we return. Big moment for retail earnings is upon us, and investors watching closely for signals of how tariffs may be impacting spending and investments. Art Hogan joins us now. He is Chief Market Strategist at B.Riley Wealth. That firm has more than $4 billion in assets under management. Welcome, Art. As always, my friend, it is great to see you. So let's talk about these retailers. So Home Depot reports, Art. Investors obviously like what they heard from that name. We're popping about 3% in today's trade. A rush of more names are coming, Art. I am curious just broadly, when you look at these retail earnings, you're going to look at the reports, Art, you're going to listen to the conference calls. What are you watching and listening for, Art?
Well, two of the biggest things, it's foot traffic and tariff mitigation strategies, right? So those are the two things you need to key on and how well can companies do. So Home Depot got a pass They missed on the top of bottom line, but we know they had a terrible spring gardening season. So, it probably rained where you were, Josh, for 6 Saturdays in a row this spring. So clearly that didn't help. Their comp was a little light, but they kept the guidance the same. So I think that was a positive. So it's all about how you address the higher input costs. Walmart's probably the best set up for this, and they'll be reporting this week, and they're the best set up for this because they really have the ability to use their entire portfolio and not just raise prices on those things that they're importing with tariffs now, but look at everything, check the elasticity of demand and say, okay, instead of putting in a 10% increase on these things that we are definitely importing that have tariffs on them, we're going to look at what we can do across the entire portfolio and balance that out. I think one of the biggest surprises this week is going to be TJX. People forget that TJX gets at least half of their inventory from the department store chains, and when there's too much inventory in the department store chains, they actually benefit from that. They're not paying tariffs on that, so they're buying that. They're the discounter that buys that at the discount. And consumers love that sort of treasure hunt mentality. The value-focused consumer loves that. So I think TJX is probably the surprise. Now, unfortunately, it comes into its report at or near an all-time high, so that's always difficult. But I think of the big reporters this week, that's probably the one you want to keep an eye on.
So as you note there, Art, these retailers give us this great line of sight into the consumer. What is your take of the consumer, Art? I mean, how healthy, how resilient?
Well, I'll tell you this, we just got retail sales last week, and they were better than expected, at least in line with expectations. So, again, Josh, the death of the American consumer has been exaggerated. That said, when we look at the jobs number, and now that we know what the revisions looks like, we're creating 35,000 jobs on a monthly basis. That's down 125,000 jobs on a monthly basis at the fourth quarter of last year. And the increase in wages has slowed down at the very same time that the consumer is going to be facing higher core goods prices. And we don't know exactly what that's going to be until we cut a deal with China and Canada and Mexico, but we know it's going to be higher. So that consumer is facing some headwinds, but that's why the consumer has been pushed into things like the value chain, right? Like Walmart and Costco and TJX. And I think they'll continue to be the net beneficiaries of this. The other important thing to remember, Josh, is we have consumption patterns where we consume about 65% services and 35% goods. So the good news is it's not the biggest part of the wallet that's being affected by tariff prices. The bad news is you're going to see consumers get squeezed, that we're going to probably see that more in the third and fourth quarter.
On tariffs, Art, it is interesting because very smart people come on this show and they have very different opinions, Art, about that. I will have some come on this show and say, just you wait, Josh. Just you wait. That pain is on the way. It's coming. Others say, you know what? Take a deep breath. The boogeyman of tariffs, it's just not going to be ultimately as scary as some of those dire forecasts suggest. Where do you shake out here, Art? Or do you say, listen, it is too soon to say?
Well, a couple things. First and foremost, we started this year with the average tariff rate on imported goods being 2.5%. By the time we get to the exit ramp on this trade war highway, we're likely going to sit somewhere between 15 and 20% of imported goods that have tariffs. So that's a significant increase. That said, of that 15% increase on core goods that have tariffs on them, about 10 to 15% is usually taken in by the exporter, 10 to 15% is taken in margin losses by the retailer, let's say, and then the consumer gets hit with 70% of that. So it's not necessarily as startling as it is, but I think it's also important to remember there's some switchability. You certainly have the ability to make changes as to what you're going to purchase, and we just don't purchase as many goods as we do services. So yeah, I sit in the middle of that. It's certainly not a positive. And it's certainly, it's certainly not a terrific thing that we should ignore. We're going to start to see that flow into economic data. We're just starting to see that now.
Art, broader question. The markets, I know, we're dipping today, but what a move. I mean, the SPX is up about 30%, Art, from that April low. When you're talking to those B.Riley clients, they ask you where we go from here. What are you telling them right now, Art?
Well, a couple things. So first and foremost, I would say, yes, significant bounce off the April 8th lows, not just for the S&P, but certainly the NASDAQ, in a straight line. What's interesting to me is as I went back and looked at how the major indices did, the Russell 2000 is actually outperforming the S&P 500 from the lows of April 8th. Now, it's coming from a lower base, and it's been underperforming for multiple years now. But if we're actually going in an environment where interest rates are coming down, you check the handbook for that, and you want to start looking at small caps. The gap between small and large hasn't been this wide going back to 2000. So we're talking about 25 years since we've seen the gap between small and large. I wouldn't sleep on the small caps right now. I think it's their time, and I know a lot of people have been saying that for a while. but there's a lot of catalysts that can drive that right in the short-term horizon.
All right, so don't sleep on the small caps. I'll end here, Art. I also know you do advise this kind of barbell approach. What is the barbell?
So on one side, we'd like to keep a market weight in the AI darlings, right? So we don't want to be overweight, and you get overweight pretty quickly when they've had the kind of run that they've had. On the other side of that, we like the AI adjacent industrials, right? The industrials, to build out the infrastructure, to build out the data center, certainly to fix our electric grid. I like the dereg play as financials. That's another piece of that barbell approach. And we haven't seen the positive effects of lower interest rates and deregulation on the financials just yet. And I think that will continue to show itself in the back half of this year. And the third leg of that is healthcare. One of the worst performing sectors of the year. I think we've sort of washed out all the changes in reimbursement rates. And I think that healthcare's certainly got a chance to bounce here. So those are the three things on the other side of the barbell. You try to readjust that quarterly so you're not overweight on either side of your barbell approach.
Art, always great to see you. Thank you for joining us.
Thank you.
All right, now time for some of today's trending tickers. I'm here with Defiance ETF's Sylvia Jablonski. We're taking a look at Opendoor, Palantir, and chip stocks. Let's start here with Opendoor. Those shares reversing earlier gains. The company continues its executive search following the departure of CEO Carrie Wheeler. In the weeks leading up to her resignation, Wheeler faced immense pressure from investors who argued she was the wrong leader to shepherd the company. This one, we were higher today, Sylvia, as mentioned. Now we're down by about 4%. Of course, this stock attracted a ton of attention, interest, moves in the C-suite. I spoke with hedge fund manager Eric Jackson on the show. He was pounding the table, laying out the bull case for Opendoor, but what do you make of it?
Yeah, I mean, this is a stock that's been up over 130% year to date. It's still up quite a lot for the month of August. It's just had this parabolic move, and I think that it also had some meme qualities to it, right? There was a lot of retail following to this stock. And it seems like this leadership move, initially there was a positive reaction, right? That there would be a new shepherd to bring the company to where it needs to be. But really the story here is that the company is very capital intensive, right? And so they need to kind of transform into that next gen company. They need to be the Airbnb of housing, and everything has to be essentially digital so that they can kind of manage all of the sales start to finish in an AI platform, online, fully digital, and become less capital intensive. So I think that the closer they get to that from where they are in terms of being more capital defensive or needed is when you will kind of see that start to break out and be a good AI play in the housing space.
All right, well, Opendoor's one hot name. Let's talk about another. That would be Palantir in the hot seat again, following a short report from Citron Research. Citron knowing that the company is now detached from fundamentals and analysis. On this one, so Citron short Palantir. I heard Citron's Andrew Left in an interview basically saying, listen, he likes CEO Alex Karp. He was talking about how he likes the company. He just doesn't think the valuations make sense. I've had others, Sylvia, listen, I think about Piper's Brent Bracelin, right? He likes his name. I had Brent on. Brent was saying, listen, this is richly valued, but he is telling his clients to stay overweight because he thinks it's just that unique in terms of its technology. But what do you make of it?
Yeah, and I would agree with that. I think that there are certain stocks out there that are richly valued, but they sort of justify it in terms of their future. But what Palantir is also doing is you're seeing it play out in the earnings, right? They had a solid earnings quarter. They have a very positive outlook, close to 50% year-over-year revenue growth. I mean, they're looking really solid here. And I think with Palantir, you have that $10 billion government budget over the next 10 years. They're kind of the pick for aerospace, defense, and surveillance, whether it has to do with immigration, whether it has to do with geopolitics, investment by the U.S. That's a huge, ballast for them. And then the other thing is their commercial operations are massive. So I think that they do something that is truly unique, and they're a leader in the space. And so I think that this stock sticks around and becomes a top pick. And when you see a stock like this fall, I wouldn't be surprised if there was buy dipping on this one. We'll have to wait and see, but it's a stock that investors tend to go back into when you see these pullbacks.
Yeah, Brent Bracelin called it a one-of-a-kind growth and margin model. That's what he said today.
I like that.
Lastly, we're going to take a look at the chip action. Intel get a nice pop as SoftBank is set to make a $2 billion investment in the company's common stock, but other chip names seeing some decline in today's trade. You can see those there. Intel's interesting. The headlines just kind of keep coming, Sylvia. So SoftBank, okay, they're going to agree to take this $2 billion stake in Intel. Then we have this report that the Trump administration is thinking about taking a stake of about 10% in the chip giant. Bernstein's Stacy Rasgon, smart guy, friend of the show, he told his clients, he summarized it like this. He said, Intel was originally, Stacy says, supposed to get these CHIPS Act funds for free. giving up 10% of the company for them seems worse. But what do you think?
Well, it seems worse, but we've been talking about Intel and the turnaround of Intel that has just not come to fruition, right? Over the last couple of years, this is the company that U.S. government has invested in. A lot of different corporations, large institutions, leadership changes have happened at Intel, and they haven't quite gotten it. And I think the good position that Intel is in is that there's a lot of U.S. activity here, right? And that's very supported by this administration. And so if you get a lot of cash kind of pumped into this and a lot of partnership and potentially purchases of their chips, it's something that could turn the company around.
Let me ask you this, though. So as an investor, if you heard, okay, and let's say really Uncle Sam does take a 10% stake in the company.
Yes.
Does that get you excited? Do you think, okay, that really addresses the core challenges for the company?
I think, you and I talked about this a little bit off camera. I think it's a different type of Uncle Sam, right? I think that this Uncle Sam is highly interested and invested in the future of AI and innovation
and builds it as a national security decision, we should say. Yeah,
exactly. And so I think that there's a lot of merit to that. If you were at Intel, I don't know what their view is in terms of private funds versus government funding, but I do think that there could be different types of synergies and partnerships where the chips are then purchased and used for different government-related projects, and so we'll have to see how that.
A different kind of Uncle Sam.
Yeah.
We'll leave it there. Coming up, shares of Viking Therapeutics sinking as its weight loss pill disappoints. We're going to discuss the stock moves and the state of the GLP-1 trade. Stay tuned. Shares of Viking Therapeutics are sinking as its weight loss pill disappoints in a mid-stage study. For more, we're bringing in now Yahoo Finance senior health reporter Anjali Kamladi. Anj.
That's right, Josh. We got news from Viking that its pill for weight loss has a 12.2% weight loss amount, and that is pretty much in line, really, with Eli Lilly. If you look at the difference between the two, it's not that far apart. But what investors are really looking at is actually the drop-off rate from the drug, and that has also been something that pressured Lilly's stock when it released results for orforglipron. So what we're looking at right now is how investors are thinking about the comparison, as you see on your screen, between the numbers that line up for the injectables, that's the Zepbound and Wegovy from Eli Lilly and Novo Nordisk, compared to the lower weight loss results seen from these daily pills. Now, what is at stake essentially is what becomes of this weight loss market. Initially, when the announcements of all these candidates came to play, it looked like it was going to be a pretty heated race. It looked like, the pills were going to really blow it out of the market and completely shift the dynamic. But it seems like the side effects from the injectables is less concerning for patients. And so with the drop-off rates we're seeing in the pills, it's unclear how that is really going to be affecting the market. You've got an analyst commentary ranging from, shut the door on the competition. It's Eli Lilly, Novo Nordisk with their injectables, and that's it. Important to note that Novo Nordisk is also trying to get an approved weight loss pill. It is essentially extending the indication for its pill that's already on the market, Rybelsus. Meanwhile, other commentary is really pointing to the results. The weight loss is fine, in line with Lilly, and the market is essentially overreacting with what you see now is a 42% decline on the day.
Anj, do we know generally how do the oral versions of these drugs, how they sort of stack up, Anj? How do they kind of just broadly compare and contrast to the injectables in terms of weight loss and side effects?
Yeah, the side effects is the part that's really key and different here. There are more what you call sort of gastrointestinal reactions. There's more nausea, more of those kinds of reactions as compared to that's not to say that they don't exist in the injectables. It just seems like there's maybe they're more aggressive or patients just don't have the tolerance for them. There's also been questions about, the timeline of the clinical trial, comparing Viking's shorter trial period to Lilly's longer. And even though they saw a drop off of patients, the number in Viking's trial data shows less tolerance, and that's questions are arising about whether or not that is just the the clinical trial pool, the pool of patients that now exist, considering how many people have already been on, the injectables and the like. So that's sort of where the question is what kind of a market are we dealing with right now? In terms of the comparison of the weight loss, if you just saw that screen before where we compared Eli Lilly's Zepbound as well as the Wegovy from Novo Nordisk, Eli Lilly has sort of set the standard because of the high results from Zepbound, and the oral pills fall kind of in line with what Viking shows. And so that's been sort of the question that investors have is, what does the market look like? Will there still be this strong pull for the pills with their lower weight loss percentages compared to the results you can get from the injectables?
All right, thank you, Anj. Appreciate it. Sylvia, I want to bring you and get your thoughts as well. Before getting to what I know you like, your thoughts on some of those names, just broadly the sector that we were just discussing there, these sort of the established go-to drug makers, the Eli Lilly's, the Novo Nordisk. As an investor, do those excite you?
Yeah, I think they're kind of steady Eddie stocks, right? I think that these are names that do a lot of things. You have the GLP-1s, which obviously bring in loads of revenues, and they have Alzheimer's drugs and diabetes drugs and metabolic disease research and things like this. And so I think that, and given the amount of baby boomers that we have that are aging and the need for the different pharmaceuticals that they offer, they're companies that are good defensive plays, they're good diversifiers, they tend to pay high dividends. I think they're solid portfolio contribuders for those looking for health care.
So there's a role for them in your portfolio.
There's a role, yeah. There's a place for them in a portfolio, I think.
But I know what excites you. You do like healthcare, but broadly, before getting to names, when you're looking for what does excite you in healthcare, what are you screening for?
So when I think about healthcare, I try to look at every sector with the lens of kind of the future and the future of technology and how they're morphing along with the generations and things like this. And you have these digital healthcare companies, for example, like a Hims and Hers, things like this, companies that do everything kind of like online, digitally, discreetly. You have this massive total addressable market for both men and women, whether it's for GLP-1s, whether it's for hair loss issues, whether it's for some of these other discrete types of treatments. And I think that you're seeing, when you listen to their earnings calls, you're hearing about how much their audience and their captive audience and its increase in customization for health plans and things like that is increasing. It just makes me want to keep an eye on some of these future tech AI healthcare types of stocks.
When you're looking at a company potential investment and you want to see this cross section with AI, which I know excites you a lot,
yes.
and it excites a lot of people, how do you sort of screen, Sylvia, to make sure, to whether the AI story is real and legitimate versus marketing fluff?
Well, I think in healthcare, it's fairly easy to scope out, right? So I think the classic healthcare companies could use AI for drug trials and things like that. They might talk about that. They might get improved results. And I think ultimately that will impact their bottom line. But I think the digital health companies, they are running on AI, right? The whole platform is essentially technology, AI, digital solutions, and things like this. And so I think that in today's world, that just has, again, like a larger total addressable market and opportunity.
All right, Sylvia, appreciate it. Coming up, window or aisle? We fly you through our airlines playbook, the latest travel trends and stock moves. Stay tuned. Chamath Palihapitiya, known as the SPAC King, is making a return to the game of special purpose acquisition companies. The venture capitalist filed to list a SPAC under the name of American Exceptionalism Acquisition Corp. The return of Palihapitiya comes after being the public face of the SPAC mania during the original boom and bust. Here to discuss the SPAC landscape, we got Sylvia Jablonski from Defiance ETFs. Sylvia, I'll just mention a bit of context with this, courtesy of Bloomberg, which does note of Palihapitiya's 6 SPACs to complete deals. Only SoFi is trading above its $10 IPO price. The others have seen median losses of 75%. Wow. But give me your take on the general theme trend. What do you make of it?
Yeah, I mean, that's actually not so uncommon, right? When you think about the numbers and which new type of startup will actually succeed and do well, it's actually not so surprising. But yeah, the big SPAC boom happened in 2020, 2021. And I think, you had so many SPACs coming to market and there was a lot of investor interest and investment in these vehicles and investment in funds that gave you access to these vehicles. And then 2022 came, the tech crash basically, and a lot of it fell apart. And so I think right now you just have this risk-on environment environment in the market where a lot of investors are more interested in SPACs and IPOs. The activity's picking up again, and there's kind of this fervor.
But let me ask you this, the fact that we're back talking about SPACs like this, and I take your point about it, but I do think a lot of people look back at the SPACs.
Yes.
Maybe with not such fond memories. I mean, I think I just wonder, you're talking meme stocks, you're talking SPACs. Is that a sign to you of froth in the market? Is it a sign to you of market exuberance, Sylvia?
Well, I think the sheer number of SPACs right now is far lower. I do think, again, in 2021, that there was this exuberance with SPACs, and what happened is a lot of them came to market, a lot of them just didn't make deals. A lot of them did not become profitable, right? You had a lot of big names coming to the market with SPACs that just never ended up doing a deal. And I think with Chamath Palihapitiya, he has a little bit of a better history in terms of just running businesses generally, although he's had quite a few SPACs that didn't work out. When they hit, they have hit. And so I think this American exceptionalism SPAC makes a little bit of sense just in terms of, we were talking about Uncle Sam and where the government's going and what the focus on,
you mean it makes sense because it dovetails with
I think
the
it's thematic in terms
goals?
of, the administration's goals, the market, probably the appetite of the market for the next 3 years. And so I think it will probably attract some interest from investors. But just in general, I just think the market's a little bit more ripe for SPACs and IPOs, and risk on attitude.
So it doesn't concern you? Because I've had other folks say, man, memes and SPACs, that gets me a little, it's not so much fun, they say, it gets me a little concerned. It doesn't sound like you share that, though.
No, I think a SPAC is a vehicle, right? You can IPO in different ways, right? You can do it through a SPAC, or you can do it kind of the classic way, and I think it's just another way, it's just another way to bring a new company, a new filing to the market. So for me, whether you call it a SPAC or just a classic IPO, it doesn't matter so much. It's what's in the pudding, and what's the content of it, and kind of what happens.
What's in the pudding?
Yeah,
leave it there.
Rates are coming down. Risk on. It could be interesting.
Risk on. Thank you, Sylvia. All right, with the summer travel season winding down, the holiday season picking up, airlines competing to grab the lion's share of consumer travel budgets. We're navigating how to play the airline sector with the Yahoo Finance playbook. Joining me now is Peter McNally, Global Head of Sector Analyst at Third Bridge. Peter, it's great to see you. So, if we look at the sector, Peter, the ETF that tracks the sector, JETS, you're actually close here to 2025 highs. Summer being nearly over, I'm interested to get your broad take. What did we see? What did we learn about the sector? How solid was it?
It turned out to be a good season, overall. I think at the start of it, everyone was concerned about tariffs and a potential recession and revenue declines in the sector, and it turns out like that was not the case. The issues are more the old ones that we've been having 2023, 2024, which were about getting planes, that work and fly, and costs. And, within that, the major carriers like United and Delta are at an advantage. They've got about 1,000 planes each. They're not as dependent on new deliveries from Boeing and Airbus. Their costs have become a lot more competitive with low-cost carriers. So they've been competing in the leisure markets a bit more than in the past, but the diversity has played out well. For low-cost carriers, they haven't been as low cost as they once were. The delivery schedules have really impacted them, and it's not just new aircraft; it's also engines as well. Has been a bottleneck for years now, and that's not going away. So those challenges remain, and there's a bit of a haves versus have-nots. But as I said at the beginning, overall, this is a pretty good summer for demand.
What was the demand? How does it break down between consumer and business? What do we see there, Peter?
Well, I think even within the consumer, the big play is this premiumization, right? And let's just take Southwest as an example, which always had the same seats for everybody. They're investing now in redoing their cabins to offer a premium economy. And that is, also the demand for some of these new planes, that it's easier to do that. But within premium economy, this is where United and Delta and American and these guys do make a lot of money. So consumers are, the average consumer is willing to pay a little bit more. The business travel thing never got quite back to, pre-COVID levels. Some business travel got cut out, permanently. But a lot of it did come back. Now, while those are, really profitable customers for these airlines, the big play has been in the premium economy section of the plane.
How generally, Peter, did international look?
International's actually been quite good. I mean, Asia has still been slow, right? China, it's not news to say that the Chinese economy has been weak, and we've got this trade war that continues. But demand to Europe has been pretty good. We've seen less of it coming the other way with European carriers flying here. There has been some pushback there, but as far as Americans going to Europe and South America has actually been pretty good, and this has manifested itself in the results of those big three U.S. carriers that we talked about.
There was a Bloomberg story, Peter. I don't know if you saw this. It noted this interesting trend I want to bounce off you. They talked about how leisure and business travelers are waiting, they say, until the last minute to book air travel. That's interesting. What do you make of that, Peter? What could explain that? What is that? What challenges does that possibly pose for airlines?
Well, look, it makes capacity planning, really tricky. And I think this is something that we saw really at the onset of the recovery post-pandemic. And, again, the advantage is on larger carriers who've got more planes that they can move around to meet this demand as it comes in. But the interesting thing, I think, to watch that we've been doing a lot of work on lately is AI, and how airlines are using that to price and maybe understanding some of these patterns that are emerging in real time as customers look, to book these things very short term. I think airlines, particularly Delta, we would note, has been effective in pricing to meet that demand that doesn't have a whole lot of visibility.
Do you expect that trend right now? It's Delta, Peter. Is that going to become much more popularized throughout the sector, you think?
Well, look, we think that large carriers like Delta have an advantage, and just they're as well capitalized as any business out there to invest in this stuff. But it's a low single digit percent of sales today. Our experts at ThirdBridge are telling us this could be 20% by the end of this year, and potentially like 50% next year, leading to potentially 2 to 3% pricing growth alone, just from this single trend. And in a low margin business like airlines, like that really can help fall right to the bottom line.
As somebody, Peter, who recently had to book tickets for his family from New Jersey to California, I'm curious, what do you think pricing looks like now and ahead broadly?
Well, for the next few months, it likely eases off. We're through the peak demand season, or we will be in about a week and a half. Right. And then mid-September, right up until about Thanksgiving, we're going to see this dip. But the thing we will be looking, for some more guidance from the companies in the weeks ahead is how much capacity they're planning on adding for the Christmas season. What does that look like? And we saw, visibility take a dip there in April ahead of the summer travel season, but it came back quickly in May. So I think really to get to the point of the question, I think you're in pretty good shape as a consumer for September, October, and early November. But for the holiday season, it certainly can be a bit more expensive and pricey.
Final question, Peter. Jet fuel price trends. What are we seeing? What do you expect ahead? What does that mean for the airlines?
Well, this has been a tailwind, and the one thing about fuel is it affects all the airlines equally. Delta owns a refinery, but it doesn't impact the bottom line like that greatly. I think our experts would tell us in the months ahead, oil prices do look weaker. It seems to be an oversupplied market, and that likely put some downward pressure on jet fuel costs in the months ahead.
Peter, always great to see you and to have you on the show. Thank you.
All right, good to see you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.